Hi, I'm Carrie Millar, and this is the four most expensive commercial insurance mistakes growing practices make and how to avoid them. Thank you for joining this webinar. I really appreciate it. So who am I? As Carrie Millar, I am a risk manager, insurance advisor for Dentist Insurance Services. I've been doing this for 22 years. I like to say I'm an insurance nerd because my undergrad is in insurance, but I also am a foodie, a traveler, a wife, a mom, and I have two twin 13-year-olds and a 16-year-old. So I am a wine drinker, of course, since I have a lot of teenage angst in my house. But more importantly, I'm an advisor, and this is what I do. And so everybody has their experts and their roles to play, and this is what I really enjoy. And so I kind of like to call myself the closet organizer of the insurance world. People come to me with all their different policies, and I like to go through and look at the duplicate coverages and get it all organized. And I work for Dentist Insurance Services, and we are a national insurance agency brokerage that specializes in dental practices. And we have about 12,000 clients nationally, from individual practices up to hundreds of location corporate offices. And we're in 32 states, but I'm sure in the next few weeks it'll be 34, 35. We add states as our clients come to us and grow into other states, or new clients hear of us. So we can pretty much write in every single state. And because of that, we have great partnerships with insurance carriers. We are not a carrier ourselves. We are the brokerage. So we are chairman's level brokers with the Doctors Company. We are president award winners with Liberty Mutual, Hartford, Hanover, Chubb, Coalition Cyber. So we have found the best policies for practices with the best coverages based on what dental offices and dental groups and DSOs and dental partner organizations, DPOs do, and just how they're all done. And I report to a board of dentists, and we were established in 1989. I have a team of 25 across the country in all of the time zones. So it's not just me and my desk here. I have a large group behind me. So we're going to go ahead and get started. And the reason why we see these mistakes is because there's kind of a growth trap. A lot of dental practices start out with 1, 2, 3 locations, which is great and where you should be. And they have a local agent. It's their state farm rep, or their somebody that they went to high school with, or somebody that's in their church, and they are a generalist. And so a generalist agent knows the community. They don't particularly know all the insurance ins and outs of every small business. Most of them probably also sell homeowners insurance. And that's great for when you have a small amount of risk. But as you grow, you have more providers, more employees, deeper pockets, and that increases your liability and your potential for loss. And so it just builds and builds. And you also have a situation where a lot of you are going to start adding new entities and new structures. You have friendly PCs, you have holding companies, you have land, the build codes. So as you change your structures, and as you grow to new states, you might understand what's happening in your state, what's expected of you as the employer. But you moved to Massachusetts and you didn't know you had to provide paid family leave, or you moved to Ohio and you didn't know that you had to have workers' comp in their state pool, right? Every state's a little bit different. And if you don't have an agent that understands your structure, where you're at and what you need, you can fall into some of these big mistakes. So mistake number 1, not having a group malpractice coverage policy. I cannot say this enough. We have had some claim scenarios and it can get really bad. So here's an example of a claim that actually just happened. And we don't need to talk about whether the claim was right or wrong, if we should have paid the patient, but basically we have owner Olivia, who has an established patient who came in for a root canal. Now, a few months later, the patient developed pain near the treated tooth, and Olivia was away. So Associate Aaron saw the patient, noted an underfilled canal, recommended some retreatment. The patient subsided. They didn't come back. After the procedure, they went back after some routine care, right? They saw Aaron again. They saw Olivia again. So they have now seen 2 practitioners at this office, and they filed a suit. So now we wonder whose insurance is going to cover, right? Is it going to be the practice's coverage? Is it going to be the associate's coverage? Is it going to be the owner's coverage policy? And what structure do you have in place to make sure you have coverage no matter what happens? So let's look at those structures. A lot of times people say to me, it's okay, I let everybody carry their own policy. And they don't have a corporate policy, and they do not have a separate corporate entities. Now, sometimes owner Olivia will have her corporation on her policy. Great. However, that does not cover the corporate entity for anything that Dr. Aaron does. So in this situation where everybody covers their own policy and there's no corporate coverage, the corporation does not have coverage. Dr. Olivia would, and Dr. Aaron does, as long as they pay their premiums, but the corporation doesn't. So if the corporation gets named in a lawsuit and they are not listed on either policy, then they have no coverage. They have no coverage, no defense to get them out of the claim. They have no coverage in case anybody was awarded on their behalf. So this is a situation where there is a liability. You have an opening. Now, a lot of people say, oh, we let dentists carry their own policy, but we make sure that we're named on the policy. Great. You should absolutely be named as additional insured on any associate or 1099, or if you had an anesthesiologist or somebody or a subcontractor come in 1 day a week, 1 day a month, you want your entity to be named on the policy, right? However, that does not mean always that there is coverage, because people don't always pay their bills. If you don't control that policy, we don't know for sure that it's in place, right? I have a pretty large group that has 20, 30 offices. They let everybody carry their own coverage. They do collect certificates of insurance that shows that they're named as additional insured once a year. Great for them. There are so many offices that say, oh, we asked to be named, but they don't look at it. They don't check. They don't want to make sure. But I've had several policies cancel for non-pay. I mean, we get it daily. People cancel for non-pay, and they don't mean to cancel their policy. They had Associate Aaron had every intention of adding Dr. Olivia's corporation, and he had every intention of having a policy in place. But if he has a claim and he doesn't have a policy, then the corporation doesn't have coverage either. And Dr. Olivia's policy, in most situations, even if she has her corporation named, is not going to have coverage for the corporation for something that Dr. Aaron did. So she might have coverage for the corporation for her work, but if it is not a corporate entity policy, then it does not have coverage. So how do we do this? Well, every dentist can carry their own policy, and the corporate policy can have their own separate coverage. Well, that's great. So now we have a policy for the corporation, a policy for Olivia, and a policy for Aaron. But is this sustainable? At some point, you have a team that is trying to track down all these certificates of insurance, and you have a team that has multiple renewal dates, right? So now you have administrative issues, compliance, credentialing, right? You also have no scalability savings, right? If you have a group with multiple providers and you are low risk and you have a great risk history, you should be getting better rates. You should be able to offer that as a benefit to working at your office. So you're missing out on the scalability savings. But the two bigger problems with this are the carrier finger pointing when you have multiple carriers involved, and the consent to settle. So if the corporation has a policy and each associate has a policy and the owner has a policy, we have tons of policies. And if they're all with the same insurance carrier, then great. We know there is not a gap in coverage, but that's typically not what happens. Typically we have policy over here with MedPro, and this one's with Dennis Advantage, and the corporate policies with Hudson, and this one has Hamilton, and everybody's different. And so because of that, instead of going after the patient and defending against the care that was given, each carrier is going to say, nope, it wasn't my insured, it was your insured that did it. And now we have all these finger pointing and too many people involved in this lawsuit. And in that situation, it ends up settling much higher than it would be if everybody had the same carrier. And we're also talking about settling and consent to settle. I firmly believe that a provider should have a true consent to settle. It should be up to them whether they choose to take a deal or not. You don't want that to lie with the insurance carrier. So in states where that's legally allowable, we totally promote a true consent to settle policy. For a group policy, the consent to settle can live at the corporate level or at the provider level. Now, the corporate level can give that down to the provider level, but ultimately it will stay with the first named insured. As the corporation owner, you might have a situation where it makes sense business-wise to go ahead and settle for $20,000, $50,000, $100,000, and you might have an associate on your policy or an owner or anybody who just adamantly does not feel they need to settle, does not think they want to do wrong, will not take into consideration the consent. And so a group policy gives the true consent to settle at the first named insured. So in a true group policy, there is a group policy. The group policy goes ahead and schedules every single provider. They have essentially their own bag of money. There's one renewal date, and the entity can either share in everybody's limits or they can purchase their own set of limits. That's their own bag of money that can be pierced outside of the providers. This is the best way to stack a group policy. We typically recommend that people do this starting at 5 associates. You can do it as long as 2 people are on the plan. You can form a group. It's great because people can be scheduled on, scheduled off. We love it. And it really solves all the situations. We know that the corporation has coverage. We know Dr. Olivia has coverage. We know that Aaron has coverage because he doesn't pay his bill. We pay his bill. Do we make him reimburse us? That's up to you and your individual contracts. But as long as you're paying the premium, you know that the premium's being paid. If you want him to reimburse you, if it's part or her to reimburse you, it's part of the benefit package. That's between you if whether you decide to pass on those costs or not. But at least you know they're being paid. Your credentialing and your accounting team love you, and your compliance team, because there's one policy, one renewal. You'll get a certificate that has everybody on it. You can also get individual certificates, and it just makes it so much easier from an administrative standpoint. Now you have a group. At some point, your group is going to get big enough that you go to the carrier and you say, look, I have a great loss ratio. I want a bigger loss-free discount. I'm in multiple states. I'm spread out. I'm a specialty. It doesn't matter. You go ahead and you ask for that scalability savings, and the true consent to settle is in place at the entity level. So a lot of people ask me, should I have a claims-made policy or an occurrence policy? And both policies are good, and both policies cover you if you're an individual dentist or group dentist and the policy is enforced. It's when the policy is not enforced or when somebody leaves that you come into this complication. So I typically ask the same questions. One, are you planning on growing or selling? If the answer is yes, you want an occurrence policy. The administrative work of going back and forth of trying to track down tail policies, of charging for tail, things like that, is a huge pain. And also, if you're planning on selling later to a larger group or to other people, it makes sense to have an occurrence policy because it's a really cleaner situation. You don't come in with having to figure out if they're going to pick up your claims made and your tail, or if the new group's going to have to pick up the retro and how it works. So if you come in with a nice occurrence policy, it makes the transaction really quick and easy, and there isn't a lot of questions. Now, let's say you have 5, 10, 20 associates. You don't plan on growing anymore. You don't really plan on selling. That's not in the near future. Then you need to ask yourself question 2. Am I going to pay the tail if associates leave? Now, I either way, it's up to you. We don't charge the tail to the individual associate. It gets charged to you. So if an associate leaves, you have to pay for the tail, and then you have to track them down and get the premium for the tail, or you have to eat the tail cost yourself. So if you are going to pay for the tail no matter what, then yes, get a claims made policy. Because if you have a situation where everybody's on a claims made policy, if they leave, you tail them out, great. That's your business model. You're done. There's coverage. Now, if the answer is no, you are not going to pay for that tail. Okay, so now you have a claims made policy. You have an associate that's leaving that has a retroactive date, right? And now they don't have tail, or they're in charge of paying for the tail, right? So did they pay for the first policy? Now, if you are paying for the associate's policy, right, then get them an occurrence. And if you are not paying for the associate's policy, you could require them to have an occurrence. You could require them to have a claims made. You could require them to show you claims made. That's up to you. It's really hard to dictate an occurrence or a claims made if you're not paying for the tail and you're not paying for their policy. You could definitely put in your employment contractor or independent contractor that you require an occurrence form. But in most part, you should just require that they have coverage, that they name you as additional insured on their policy, and then you need to make sure on your policy you list them as vicarious. And you need to list all of them under vicarious liability so it protects you if their policy isn't there to pay if something were to happen. Okay, mistake number 2 that we see, not using blanket coverage for property. I see this all the time. If you have more than one location, 2, 3, 4, 10, 20, you should have blanket property coverage. Your risk is different, right? With one location, you know what your one major loss is in that area, right? You have one location, you have one set of limits. Now, as you get multiple locations, if you schedule on each office for a set of limits, you're paying for all this insurance and you're not able to use it at all the different locations. So let me show you how that works. In a scheduled coverage, each practice location has a set amount, let's say $450,000. So in this situation, we have 3 practices, they each have $450,000 in coverage, right? We have 1.35 million, I'm going to assume that, yeah, 1.35 million in coverage total. Now we have a loss. Practice 1 has a $150,000 claim, right? They lost a few chairs, there was a small fire, maybe some water damage, something like that. They pay $150,000 for the practice 1 because that is within their policy limits. So practice 1 has 150, it gets paid. Now, practice 2 has a total loss. Now, let's say this total loss in order to repair the building is more than $450,000. They thought that they had enough coverage in place to build out their operatories, to replace all their machines, but they were underinsured, which happens a lot lately. The cost of dental equipment, especially because you're at a replacement cost value on your insurance in most situations, the cost of building equipment, just the labor of building out a space is much higher than it was even just 2-3 years ago. So they had $450,000 in coverage. They had a $500,000 loss. They had to eat that $50,000, right? And Practice 3 has no claims. So your total loss for this year, this policy year, was $650,000. Now, in the first policy example, with everybody having scheduled, they only have $600,000 in coverage available to them because policy 1 hit some limits, policy 2 maxed out, and they didn't use policy 3. But if you have a blanket policy, then each location does not have a separate set of limits. You have one set of limits, and that is a limit for everybody. So each location still has $450,000, but instead it's now in a lump sum blanket, and that's great. We have the same loss scenario. We still have a total loss of $650,000, but because we have $1.35 million in blanket, they're going to pay all $650,000. Is the premium different for a schedule to a blanket? Typically not. As long as you're not underinsured, they're perfectly okay with it. So double check that you don't have a situation where they have a co-insurance clause. As long as you are insured to value as best as possible, that's the way to do it. Now, you have $1.35 million in blanket. If you don't have a co-insurance clause and your contents only and it's not a building, or you have a building, do we need $1.35 million? Do we only need $1 million, right? What are the likelihood that all 3 practices are going to have total losses? It's probably pretty slim. Now I have 10 offices. What's the likelihood that all 10 offices will get hit? So it's a way of looking at it to make sure, one, you kind of have coverage there for inflation, that you're able to borrow from each other's policy limits, right? And you just really is another layer in fact, and sometimes it can be a cost saving situation. And even if you don't do a blanket, let's say you have a carrier that doesn't have one available, you should at least be combining your policies when they are allowed to be combined. So my professional tip for the blanket insurance area is to also make sure that you reevaluate your office every year or so. A lot of times we are underinsured. The replacement cost of equipment is going up, the cost of building materials. Right now, they're saying between $250 and $500 a square foot to build out the inside of a dental office. That's not building the building. So are you underinsured? Please make sure you sit down and you really look at that. It's replacement cost. I don't care that you bought it 20 years ago. It's still going to be replaced at today's dollars. All right. Mistake number three is not having a comprehensive cyber insurance policy. People say cyber, security. This is not going away. Attacks are not going away. We are seeing a drastic increase. Is this because of AI? Probably. Really, really probably. Why dental offices? Well, one, dental offices don't have huge, giant money to have a lot of IT and security, so there's budgetary constraints. They don't expect you to be updating your software all the time, so they think you're vulnerable. Two, you have patient health information. This is more valuable than just getting credit cards. You have people's social security number, you have their date of birth, you have their home address. I can open up a loan. I can open up some false medical claims. I can, really use this in very nefarious ways. And it's worth more money on the dark web and to other sellers if I have all that information than just a credit card number. So the information you have is worth more, which is why they want to get it. And like we said, AI is making it cheaper and faster for them to attack you. It is letting them just ping, 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 ping all day long to try and find that needle in a haystack very easily, so that as soon as they find a small little vulnerability, they're in. Now, I'm going to go back a section because I did this great picture of this guy behind a computer. And I just want you to know that this is not what hackers look like. 9 times out of 10, the hacker that is hacking you works for a company in a foreign organization that has a building, it has HR, they work certain hours, they might get employee benefits. It is a business. It is not a situation where it's somebody in somebody's basement doing this for fun. These are ways for them to make money. This is an organized situation. Now, what should your comprehensive policy have? 1, you should have business income. Dentistry is a time element. If you are closed for 2, 3, 4 weeks, which is what we are seeing an average data breach closes people down for, right? That is money you're not going to get back. Yes, you can go see those patients in the next 2, 3 weeks later, but then that's new patients that you're not seeing. So because there is a time element to the service that you provide, the business income is crucial. 2, you want to have cyber ransom. A lot of the situations is where they come in to either your business email or somebody clicked a link and they lock up your system and they try and get into your patient health information and they send you a ransom letter and they want the ransom and they want it in Bitcoin or they want it in this cyber money, right? And you want it, 1, to be with a carrier that's going to pay the ransom, and 2, you want to be with one that is not going to reimburse you but will negotiate on your behalf. So that's very important. 3, you want funds transfer coverage. We've all seen the things where people say, oh, send me the Target gift cards, or you have people on your team that text from you saying, oh, did you tell me to wire money here, right? We see that all the time, but they're getting more and more sophisticated. Just the other day, we had a funds transfer situation where somebody went into the payroll account. They set up some fake employees. They then email blasted, spammed the office managers so that it was all, they couldn't see what was going on. And they paid these employees $20,000 each. And the office didn't know about it until they went to go pay a bill and there was insufficient funds. And so they got away with about $750,000. And if you don't have funds transfer coverage, there's no coverage for that. The office was not hacked into. There was no data breach. It was a funds transfer situation. Under HIPAA, you have to have patient notification. So you're going to have to do the expenses of that. You need to do a forensic investigation as well. You cannot just unplug your computers or have your IT unplug things and reinstall your software. Go to your last update, oh, I back up nightly, I'm just going to go back to my backups. No, if your patient information is compromised, you have to report it to all these federal and state agencies. You have to notify them under HIPAA. And if it wasn't compromised, which is great, that's why you have a forensic investigation. You want the forensic investigators to come in and say, nope, they didn't go behind our firewall, and write you a letter of authentication. And then you have that. So if somebody comes and says, oh, my information, nope, it wasn't. They certified this. I didn't have to report this to HIPAA. And they didn't breach the patient information. And now we have liability. So all of these other things happen and your patients get notified and then they sue you because their patient health information has been compromised. And we weren't seeing lawsuits. And in the last 2 years, we have started to see lawsuits. Great Expressions just settled one from 2023. There was a cluster of offices in Arizona. I think they had 2, 3 offices. They just had one. It's public knowledge. There is a wall of shame that's at the Department of Health where they list, and OSHA, that lists all the cyber attacks for healthcare offices. And it is a great place for law firms who are slow, don't have a lot to do, to go look through, see who got breached. go ahead and put some things on a class action suit up on Reddit. You can go to Reddit right now. You'll see there's some class action trying to find clients up there. So now that there's a liability cost to this, you now have the lawsuit portion of it. So typically, all of these coverages, if you have them, have one set of limits. It's one bag of money that's going to pay for all of this. It's not a separate bag of money for business, separate bag for liability. So when people ask me how much insurance they should have, I typically say you should have 2 times your monthly revenues. And that should be your bottom coverage for the policy. All right. You're saying to me, Carrie, how bad is a cyber claim? I mean, really, it can't be that bad. You know, we have like a few offices, you know, I have a great IT team, right? No, they are bad. They are bad, 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 and they are getting worse. So they typically happen over weekends. Long weekends is a big situation. So I had one that came in over a 3-day weekend. A front office assistant had taken a phone call from a patient. They asked the receptionist to check an email to see that they got their patient files. She said, oh, yeah, I see your email here. And they're like, oh, okay, can you see that link? That link has my x-rays. Can you click on that link and make sure that you got it, that it opens correctly? And she says, yeah, absolutely. Click, click, click. It comes up. It's blank. Doesn't say anything. She's like, oh, no, I can't see anything. And they're like, oh, okay, well, let me go call my old doctor. I'll give you a call back. Click. Nothing. Nothing happened. They didn't think anything of it. And then 3 weeks later, they realized they had been hacked. This whole time, the scammers had been sitting in their system, looking at what they had done, looking at passwords, looking where people were going, looking at usual patterns and things like that. When they came in on a Monday morning, all 10 locations, computers were down. There was a notification texted to one of the owners saying, we have hacked your system. We want $500,000. Then they started calling patients. They started calling employees to let them know they had their information. Now, this didn't happen the first day. It didn't happen the second day. It happened on the 4th and 5th day when the office was like, no, we're not going to pay you. We're going to restore things. And then they said, no, we have your data. And we said, oh, we don't know. And so we went back and forth. Now, in this situation, they did not have insurance with me. They didn't have a cybersecurity company. They actually had to partner with a cybersecurity that a lot of people know with to help get these people out, to help negotiate the amounts. So they were down for 4 weeks, all 10 offices. So that's $2 million in lost income. They then had to pay the technology firm that did the forensic investigation to see how far they were able to get down. That was another $90,000. They then had to use a PR firm and go through HIPAA and go ahead and notify all the patients. So all the patients, not active patients, all patient files in their system could have been compromised. They had to notify all of them. They then had to replace some of the computers, some of the software, right? Once the people are in, you can't just wipe them out. They don't go away. So you need to replace most of that computers and software because you don't want it to happen again. The bad guys don't have a code of honor. They're not going to give you the key to get your data back and then not get out of your system, right? They ended up having to pay the ransom. They were able to negotiate it down to $355,000. And then they had some PR expenses. So this is the first dollar expenses. All 10,000 of those people are now potential lawsuits. So we have a situation where one little click of an email went to a lot of things. So you definitely need to have this coverage. My professional tip is for cybersecurity, a really cybersecurity trifecta. You need to have strong cybersecurity IT, you need to have cyber insurance, and you need to have HIPAA compliance. And all of those need to work together. Strong IT does not mean that you don't need insurance. having insurance does not mean that you don't need to be HIPAA compliant. You are still subject to those fines. You are still subject to those penalties and those investigations. And if you are HIPAA compliant, that doesn't mean that you don't need to have cybersecurity and IT. In fact, a lot of what you need to have is a cybersecurity in order to be HIPAA compliant. But you can't just have IT and assume that you're HIPAA compliant. You need to have a special HIPAA compliant manual. You need to follow it. You need to have the trainings with your employees regularly. And so you need to use a great HIPAA compliant resource. All right, the fourth mistake, and I know we're moving along, but this is the biggest mistake I see. It is the easiest one to solve, and it will cost you it will save you the most amount of money, is not having a designated insurance coordinator in your office. I don't care if it's your HR, your CFO, the lead office manager, somebody needs to own the commercial insurance. If everyone handles insurance, then no one owns it. If HR has workers' comp and the CFO has the office insurance and the chief clinician or the doctors have their own malpractice and everybody has different pieces, right? It doesn't mean that there's coverage. It means that there's probably either lots of duplicate coverage or no coverage. So here's an example of something that just happened a few weeks ago to me. I had a group practice that has about 10, 15 locations, and they took on a new office. And they assumed that that office, which had office insurance, property, general liability in place when they purchased the office, that they assumed that they kept that policy in place. And the office assumed that they got put onto their master policy. So a few months go by and a car goes into the office. They are in a strip mall. The driver runs in. In this situation, they weren't even drunk. It was a little lady situation, but she runs into the office. So now we have damage. The office is damaged. They're in the front, they're come through the window. They have 4 ops that are out of commission and there's structural damage, right? So now there's repairs. So they go to file a claim with the master policy. It's not on there. They say, oh no, file it with the office insurance. Nope, the office manager let that policy cancel. She didn't renew it because they're part of this group. They don't need coverage. This is what happens when nobody owns the insurance. There's no coverage. So they lost 4 months of income, $400,000. They cost almost the same amount of money to repair the building to get up and running. They had a $775,000 loss because nobody owned the insurance. Also, there's typically duplicate coverage if nobody owns the insurance, right? Double insurance does not mean double coverage. Insurance is only going to pay out once. So if you have a property policy that covers location Y and you have a second property policy that covers location Y, you just don't have 2 coverages on location Y. You only have 1 policy. You're just paying for double, right? So I just want people to understand that. I had a situation very similar to the last one, 15 locations. They had a policy for each office building owner, practice manager, however you want to call it, had a property, a workers' comp liability for each office. So they maintained that at the office level. Then the corporate policy had an employment practices, a cyber, they had an umbrella, and there was no consistency from policy to policy. So this location over here had $1.5 million in contents coverage. It had $1 million liability with a $5 million umbrella. Why one single practice would need a $5 million umbrella, I have no idea because it didn't sit over the malpractice. This one over here didn't have any employment practices liability coverage. The corporation had one on everybody. So there was just so much duplicate coverage that when we went in, we organized it and we were able to save them over $40,000. 1, because we got rid of the duplicate coverage. 2, we streamlined the renewal process. And 3, we were able to combine as many policies as possible. Now, we understand not everything is combinable. If the friendly PCs own portions of the building or own portions of the property, depending on your corporate structure, on how the entity structure works, you might not be able to combine them, and that's okay. But then you should at least have an insurance agent who says, okay, this is what our uniform coverages are, right? Every office should have XYZ, right? We want it to be at 250 a square foot replacement cost, or we want to say that it's 70,000 per operatory. So we know how everybody has. I want everybody to have 1 million, 2 million liability limits, or we want everybody to have 2 million, 4 million limits, right? We want everybody to have an EPLI policy. We want everybody to have a cyber policy. We need to make sure that you know what those uniform coverages are and that they are making sure that everybody has them. A professional tip is to make sure that you're with an insurance agent or broker who does an annual insurance review with you. And it should include the following. There should be a list of policies with their renewal date. They should review with you your entity and your ownership every year. They should make sure that your federal ID numbers are the same, that nobody switched around, that you didn't take on any partners, you didn't take on any private equity, you didn't take on any new loans, right? All of that needs to be verified. They should have a premium comparison. You should be able to see what the difference is between your current policy and your renewal policy. They should explain to you why there was a rate increase. Maybe there was a rate increase because they increased coverage. Maybe there was a rate increase because you've had a claims history, right? You need to be explained to what is going on. Then they should give you a list of recommendations of missing coverages. This doesn't mean that you have to take their suggestions, but they should at least tell you what it is. Similar to how you diagnose people's mouse, you say, this is what's going on. Here's how we can solve it. And it's up to the patient whether they choose that treatment or not. But your insurance agent should be there and say, here's the coverages where I see gaps. And it's up to you to decide if that's a risk that you want to take or you want to close those gaps. It's a cost analysis, right? Do you need employment practices liability? Do you need to have increased cyber? Do we need to have hired and non-owned auto? You know, maybe you do, maybe you don't. But if you understand the risk and then there's a loss after, you understand why you didn't have that coverage or why you did have that coverage. And more importantly, they should have a discussion with you about what's happening in the next 6 to 12 months. Are you adding on new associates? Are you adding on new procedures? Are we getting new equipment, right? They should say, what's going to happen? When can I remind you what's going on? So that's me. Thank you, and thank you for watching the 4 biggest mistakes. I hope this was an informative webinar. If you ever want to reach out to me, that's what I'm here for. I have a whole team of individuals standing by to help out. That's why we are a silver sponsor for DEO, and we really appreciate you attending this webinar. Thanks so much.